Oil just surged again. The Middle East crisis is escalating, and yet Wall Street keeps hitting record highs. Are investors ignoring the biggest risk of 2026? At first glance, the market's resilience might appear reassuring. The S&P 500 remains elevated, the Nasdaq continues to attract capital, and investor sentiment has largely remained constructive. But beneath the surface, a different story may be developing. Energy prices are rising, geopolitical tensions are intensifying, and one of the world's most important economic choke points is once again becoming a source of uncertainty. The question is not whether oil prices moved higher this week. The question is whether markets are correctly assessing what those moves could mean for inflation, monetary policy, and the global economy in the months ahead. To understand why this matters, it is important to recognize how deeply modern economies remain connected to energy flows. Despite decades of technological advancement and efforts to diversify energy sources, oil continues to play a foundational role in transportation, manufacturing, logistics, agriculture, and global trade. When energy prices rise sharply, the effects rarely remain confined to fuel markets. They can ripple through supply chains, influence consumer prices, alter business costs, and ultimately affect inflation expectations. This dynamic becomes especially important at a moment when investors have spent much of the past year focusing on the possibility of lower interest rates. Markets have gradually embraced the idea that the worst phase of the inflation cycle may be behind us. Yet history suggests that inflation does not always follow a straight path downward. External shocks, particularly those linked to energy markets, have repeatedly disrupted periods of apparent stability. What matters here is not only the headline itself, it is the vulnerability that the headline may be exposing. According to reporting from the Associated Press, concerns surrounding Iran and the possibility of disruptions involving the Strait of Hormuz contributed to renewed attention on global oil supplies. The report noted that oil prices moved higher, while major U.S. equity indexes remained relatively resilient despite the geopolitical uncertainty. These are the observable facts. Oil prices reacted to geopolitical developments, while stock markets largely maintained their upward momentum. Interpretation begins when investors attempt to determine whether this divergence reflects confidence, complacency, or a reasonable assessment that the risks will remain contained. At this stage, the answer remains uncertain. Markets are not necessarily wrong, but they may be making assumptions that deserve closer examination. One of the most interesting aspects of this situation is the apparent contradiction at its center. Rising oil prices typically increase concerns about inflation. Higher inflation can complicate the decisions of central banks. More restrictive monetary policy can weigh on economic growth and financial conditions. Yet, despite this sequence of risks, markets have continued to display considerable optimism. This raises an important question. What exactly are investors expecting? One possibility is that market participants believe the geopolitical tensions will remain limited and temporary. Another is that investors view the global economy as resilient enough to absorb moderately higher energy costs. Up to this point, the data suggests something important. Financial markets appear to be assigning relatively low probabilities to a severe energy disruption. However, the Strait of Hormuz remains one of the most strategically significant maritime corridors in the world. A substantial portion of globally traded oil passes through this route. The broader macroeconomic implications become even more interesting when viewed through the lens of monetary policy. Over the past several years, central banks have fought aggressively against inflation through higher interest rates. The Federal Reserve in particular has repeatedly emphasized the importance of maintaining credibility in its inflation-fighting efforts. If energy prices remain elevated for an extended period, they could complicate the path toward lower inflation. This does not necessarily mean inflation will surge again, but it does mean that one of the variables influencing consumer prices may begin moving in an unfavorable direction. Markets may be underestimating how sensitive inflation expectations remain to energy costs. Inflation is not solely about current prices. It is also about what businesses, households, and investors believe prices will do in the future. Expectations matter because they influence behavior, and behavior can influence economic outcomes. And this is where the situation becomes more complicated. The global economy is already navigating multiple pressures simultaneously. Growth in several major economies has shown signs of moderation. Debt levels remain historically elevated across both public and private sectors. Governments continue to face significant fiscal challenges. Central banks are attempting to balance inflation concerns against growth concerns. In that environment, higher energy prices are not occurring in isolation. They are interacting with a system that is already managing competing objectives. This reflects broader structural pressure. The issue is not simply whether oil reaches one price level or another. The issue is whether a new source of inflation pressure emerges at a moment when policymakers have limited room for error. Investor psychology often plays a powerful role during periods like this. Markets are not only mechanisms for processing information, they are also reflections of collective expectations. That narrative may ultimately prove correct, but the introduction of new geopolitical risks forces markets to reassess assumptions that previously appeared secure. That narrative may ultimately prove correct, but the introduction of new geopolitical risks forces markets to reassess assumptions that previously appeared secure. Analysts are increasingly questioning whether recent optimism has adequately incorporated the possibility of renewed inflationary pressure from external sources. Institutional investors, central bankers, corporations, and households may all view the same developments through different lenses. For some, rising oil prices represent a temporary fluctuation. For others, they may signal a broader shift in risk conditions. The larger concern may be what this signals beneath the surface. Confidence is often strongest when uncertainty appears manageable, yet uncertainty can evolve gradually. Rarely does a complex economic challenge announce itself fully formed. More often, small developments begin accumulating until markets are forced to reevaluate the broader landscape. That does not mean a major disruption is inevitable. It simply means vigilance remains important. Looking ahead, several scenarios remain plausible. In the more optimistic scenario, geopolitical tensions ease, oil prices stabilize, and inflation continues its gradual moderation. Under those conditions, markets may conclude that recent concerns were manageable and that the broader economic trajectory remains intact. In a neutral scenario, energy prices remain somewhat elevated but not high enough to significantly alter inflation trends or Federal Reserve policy. Markets could experience periodic volatility while ultimately maintaining their focus on growth and earnings. The risk scenario is different. If geopolitical tensions intensify and energy prices rise more substantially, inflation expectations could become less stable. Central banks might face more difficult policy decisions. None of these scenarios are certainties. Markets remain dynamic, and outcomes depend on political decisions, economic conditions, energy flows, and investor behavior. The future remains open. As investors watch oil prices, the Strait of Hormuz, inflation data, and Federal Reserve signals, the most important question may not be whether markets are currently right or wrong. The more important question may be whether the global economy is entering a phase where geopolitical events once again play a larger role in shaping financial outcomes. For much of the past decade, markets often viewed geopolitical disruptions as temporary noise. Today, that assumption may deserve closer scrutiny. Economic systems remain deeply interconnected, and shocks in one region can travel farther than many expect. Whether this recent rise in energy prices proves temporary or more persistent, it serves as a reminder that inflation risks do not disappear simply because they fade from the headlines. And as markets continue pushing higher, investors may increasingly find themselves asking a difficult question. Are current prices reflecting the risks we can see, or the risks we have yet to fully recognize?